The collapse of the mighty US dollar is upon us. That is not the kind of proclamation we ever expected to hear so loudly from certain corners of the financial world. Yet, here we are. Welcome, everyone, to a truly eye-opening exploration into the spiraling downfall of the greenback, the currency some once believed was invulnerable, and how its swift decline might spark a dramatic shift across gold, copper, Bitcoin, and the entire global economy. Today, we are peeling back the curtain on the all-important question: why is the US dollar buckling under intense pressure? And what does this mean for you, for me, and for every nation on the planet that does business in, holds reserves of, or pegs its own currency to the once unstoppable dollar? In this deep dive, I will reveal 5 key factors that are pushing the dollar down, the ways in which gold and copper may be poised to soar, why Bitcoin's role as digital gold could intensify in the midst of a currency crisis, and whether we should brace for a new age of de-dollarization that might rattle traditional power structures. I will also expose some uncomfortable truths behind President Trump's "Make America Great Again" trade tactics, and how those same policies may now be coming back to haunt the world's largest economy. If you want to understand how the epic struggles of fiscal deficits, sluggish manufacturing, and shifting geopolitical alliances intersect to threaten the greenback's dominance, stick around. We will walk through the underlying data, swirl in some historical perspective, and show you what might lie ahead. Let us jump right in. Picture this scene: huge trade deficits rolling in like storm clouds, a presidency that openly criticized a strong dollar, and foreign powers quietly but steadily moving away from greenback-based commerce. It is no surprise that the US dollar has recently flirted with its weakest levels in nearly 2 years, cutting close to a threshold that could open the floodgates for a dramatic slide toward levels not seen since the middle of 2021. Skeptics might call it alarmism, but the charts do not lie. So, what exactly triggered this mess in the first place? First off, we have the "Make America Great Again" approach associated with President Trump's earlier term. The administration harbored a clear dislike for a strong US dollar on multiple fronts. When you want to boost local manufacturing and make your nation's goods highly competitive abroad, a powerful domestic currency can be a thorn in your side. If the dollar is too strong, American farmers, technology companies, and manufacturers can struggle to sell internationally. At times, Washington threatened to intervene in currency markets to tamp down the greenback's value. Do not forget, too, the repeated calls for lower interest rates, a policy that typically weakens a national currency by making its bonds less lucrative to foreign investors. But beyond the high-profile theatrics of the White House, one must observe the bigger macroeconomic backdrop. The U.S. economy appears to be losing steam across several metrics. Consumer demand, once robust, is no longer as strong as it was. Job creation has softened in a noticeable way, and manufacturing numbers reveal that certain industries are teetering on the edge. Under such circumstances, the Federal Reserve often responds by easing monetary conditions, cutting rates, or, at the very least, halting any rate hike trajectory. Such moves can make U.S. investments comparatively less attractive than those tied to other countries, further undercutting the dollar. But wait, there is a second big pillar here: the ballooning U.S. fiscal deficit. Even in times of relative calm, the U.S. Treasury prints and issues debt at a record-setting pace. Now, in an environment where other nations show signs of reevaluating their foreign exchange reserves, it becomes an open question whether the demand for U.S. Treasury bonds can keep up. If the appetite for treasuries dissolves, that may further pressure the dollar. Then there is a notion capturing headlines lately: de-dollarization. Countries such as China, Russia, and India are forging bilateral agreements, quietly shifting away from the US dollar as their currency of exchange. China and Russia, for instance, have already begun denominating trades in their own currencies. India and the United Arab Emirates have also explored using local currencies in select deals. The net result is subtle but profound. The global share of trades in US dollars begins to erode, challenging the long-standing assumption that the greenback will forever be the default for pretty much everything. Layer on top of that, of course, is the Trump-era trade war, an epic battle of tariff threats and tit-for-tat duties. Although intended to help American businesses by smacking foreign goods with punitive tariffs, such measures can boomerang. Trading partners do not like having trade barriers thrown at them, and they may respond in kind. Meanwhile, Businesses at home might struggle with higher input costs or a complicated supply chain, which leads to inflationary pressures or an overall slowdown in trade flows. With tensions on the rise, we have also witnessed a shift in geopolitical alliances. Traditional U.S. allies might still rely on the greenback, but nations that feel targeted by sanctions or threatened by repeated warnings from the White House have begun diversifying away from the U.S. currency. These trends were not created overnight, but they have accelerated with time, especially as the world environment looks less stable. Some countries now fear the U.S. might weaponize its currency, thereby restricting access to dollar-based payment systems. So, they are hedging their bets, just in case. Does all this mean the U.S. dollar could plunge further? Well, if we look at the technical charts, we see that the U.S. dollar index, the DXY, has slipped below key support lines. It is only a stone's throw away from challenging the low it set around July of 2023, specifically in the mid-90 range. Should it decline further, the next realistic floor is that 84 to 89 corridor from the first half of 2021. That is not speculation alone. It is basic technical analysis. When price action on a weekly or monthly chart cracks major support, the path is often cleared for a substantially deeper fall. In other words, the million-dollar question is, who stands to gain when the greenback's brilliance starts to fade? It turns out that multiple markets react in interesting ways. Historically, commodities priced in U.S. dollars, think gold, oil, copper, silver, often become more attractive in the eyes of foreign buyers when the dollar weakens, since those buyers can then pay fewer units of their own currency to purchase the same amount of metals or oil. Let us first consider precious metals, gold in particular. There is a long-standing notion that gold is the ultimate store of value, a hedge against fiat currency devaluation. A falling dollar can supercharge gold prices. One might recall times when the U.S. dollar sank and gold soared. The correlation over the last 2 decades between the U.S. dollar index and gold tends to be negative, meaning that when one goes up, the other often goes down. Some data peg that correlation at around minus 0.49 over a 20-year period. That is a moderately strong inverse relationship, supporting the argument that when the greenback swoons, gold is all too happy to climb. Next, base metals like copper can also thrive under a cheaper dollar scenario. Worldwide infrastructure projects and industrial expansions may become more affordable for non-U.S. countries when they can buy raw materials in their own currency at a lower cost relative to the dollar. Although the correlation for copper and the dollar is a little weaker than for gold, minus 0.37 by some measures, there remains a consistent inverse link throughout modern economic cycles. Copper is a bellwether for global growth, and cheaper raw materials can spark additional building booms. Now let us shift to Bitcoin, the famously volatile crypto that has been referred to as digital gold. During a period from around 2020 to 2021, as the dollar softened, Bitcoin soared to record heights, fueled by a mix of institutional adoption, rampant speculation, and easy monetary policies. While some correlation studies over the last decade showed only a flimsy inverse relationship, something like minus 0.07, that does not negate the fact that Bitcoin tends to shine when confidence in fiat currencies wanes. Yes, the data suggests it is not as tightly synced as gold or copper with moves in the dollar. Still, some online communities and hedge funds alike see each dip in the greenback's dominance as a fresh reason to park money into Bitcoin, anticipating that it will eventually function as a new store of value. But is it all doom and gloom for the US dollar? Of course not. Plenty of times in the past, the dollar has tumbled, only to resurrect itself whenever some crisis sparks a flight to safety surge. A sudden geopolitical flashpoint can lead global capital to pour back into US treasuries, strengthening the dollar in the blink of an eye. Inflation can also influence the direction, because if the US tries to tame cost of living spikes through aggressive rate hikes, suddenly the dollar becomes more appealing. So, one must keep an eye on each link in this chain, because the scenario remains dynamic. Let us re-examine some of the fundamentals that might drive the dollar's next moves. There is the question of interest rates. A few years ago, the Federal Reserve was active in raising rates, pushing yields higher, in large part to subdue inflation. But with more recent data implying that the economy is drifting downward, the appetite for additional hikes has cooled. If the Fed indeed hits the brakes on its hawkish posture and begins to cut rates, foreign investors may be less motivated to buy U.S. bonds. In turn, That can keep the dollar pinned to lower levels. Another factor is the ongoing conversation about structural deficits. The United States has repeatedly run hefty deficits, sustaining them through massive treasury issuances. The problem is, if foreign buyers hesitate to absorb that supply, perhaps because they are pursuing de-dollarization, then the cost to service America's debt can become a serious liability. Over time, such structural pitfalls have a way of eroding global confidence in a currency's stability. Then we have the swirl of geopolitics. The U.S. has sanctioned adversaries, restricted financial flows, and threatened further restrictions in the name of foreign policy. As effective as sanctions can be, they carry a subtle cost. Other nations see the U.S. controlling the global finance ship, and they wonder if they might someday be in the crosshairs too. Consequently, these countries begin stockpiling alternative currencies or gold, forging pacts with regional partners considered outside the U.S.-led sphere of influence. In a multipolar world, the unquestioned monetary hegemony of the U.S. dollar grows less certain. We can no longer deny that the pattern of de-dollarization has grown from a trickle into something far more noticeable. But here is a crucial question. Is it a short-term phenomenon, or an inevitability that is going to reshape the currency markets for years to come? Let us step back in time for context. In the mid-70s, the U.S. dollar officially severed its link to gold, paving the way for free-floating exchange rates. In the decades since, the dollar has gone up and down on the chart. Nonetheless, for the most part, it maintained its status as the leading global reserve currency. Old habits die hard, and central banks around the globe have continued to hold large quantities of dollar-based assets. Today, though, the synergy of factors, trade wars, deficits that keep ballooning, a presidency suspicious of a strong dollar, actual or threatened currency interventions, and countries forging new trading alliances, seems to be chipping away at the greenback's advantage. If this surprising twist in the currency battle caught you off guard, consider giving us a thumbs up. Your support helps us uncover more fascinating details about these economic power struggles. By now, you might be asking, how do we connect these breadcrumbs of gloom to potential silver linings, or at least new opportunities? The answer lies in the performance of commodities and digital assets, which might see a powerful boost if the dollar's slump intensifies. Gold is the most obvious candidate. For thousands of years, societies have turned to the precious metal in times of turmoil. Gold's negative correlation with the U.S. dollar is not absolute, but it remains strong. A prolonged U.S. dollar slide could put upward momentum behind gold prices, especially if market participants sense deeper weakness in the U.S. economy. When currencies falter, gold's timeless allure as a hedge against fiat depreciation lights up. Some experts see a confluence of low interest rates, a weaker dollar, and subdued inflation as the perfect trifecta for gold's resurgence. Copper is a bit more complex because its movements often hinge on industrial demand from countries like China. Nevertheless, the currency factor is huge. A discounted dollar makes copper cheaper for foreign buyers, who can then accelerate infrastructure and construction projects without ballooning their budgets on raw materials. The correlation data might not be as impressive as for gold, but the effect is far from trivial. If the U.S. dollar truly descends deeper, watch for copper to gain traction, as nations push forward with expansions in energy grids, railroads, and manufacturing plants. Now, about Bitcoin. This is where things get more speculative. Over the last decade, Bitcoin has undergone roller coaster swings, up, then down, then up again, sometimes with very little reference to what the dollar is doing. Yet, that notion of it being an alternative store of value remains compelling. The narrative that a weakening fiat currency drives more capital into crypto has never fully vanished. If large institutional players see the greenback swirling downward, and they perceive Bitcoin as a modern-day hedge, it might enjoy a second or third wave of adoption. The correlation is lower, which means Bitcoin does not always jump up every time the dollar goes down, but the possibility is certainly on the table. Do not forget that the US dollar remains a haven currency whenever storms hit. So, ironically, if a black swan event unfolded, we might see the dollar rise again in a flight to safety. That could momentarily interrupt the bullish scenario for gold, copper, or Bitcoin. Such is the complexity of global markets. One day the dollar is in a slump, and the next day something triggers a mad dash back into US-denominated assets. Still, the fundamental issues at play here, The trade war fallout, the ballooning of deficits, a slower U.S. economy, and de-dollarization are not the kind of ephemeral phenomena that vanish overnight. They reflect deeper structural shifts. The realm of finance might be on the brink of a brand new chapter in which the long dominant U.S. currency diminishes in stature, and emerging powers can claim more space at the table. As we weigh it all, we should also remember that other advanced economies have their own struggles, from the Eurozone grappling with internal divisions to Japan wrestling with deflationary pressures. So, the world is not exactly brimming with alternative currencies that are tried and tested. De-dollarization is a gradual process, but the momentum is definitely building. Now, let us peek at a few historical examples. During past eras of heavy dollar depreciation, think back to certain phases in the 70s or mid-2000s, gold prices tended to shoot upward, sometimes doubling over a relatively short window. Copper fared decently when global growth was robust and the dollar was lax. And if we look more recently around that window from 2020 to 2021, Bitcoin soared at a time when pandemic-driven stimulus flooded the market, and the dollar was not in the best shape. All these potential outcomes, rising gold, climbing copper, a possible crypto revival, hinge on whether the US dollar continues its downward arc. If the Federal Reserve reversed course tomorrow and unleashed a surprise rate hike, markets might respond with a huge shift. If inflation data rose unexpectedly, the dollar could become more appealing if investors think aggressive monetary tightening is around the corner. And, as ever, if a massive geopolitical event roils the world, the greenback might again be seen as the ultimate refuge. But as of this moment, the chart watchers see a technical breakdown in progress, with tangible real-world triggers behind it. Even more than that, the sense that the US dollar has grown too mighty for too long is prompting foreign powers to collectively chip away at its monopoly. That is what truly makes the current downturn so riveting. It is not just about cyclical economics, but also broad political and strategic moves. So, where do we stand? One possibility is that the dollar will meander at these lower levels for an extended period, giving gold and copper a tailwind and granting Bitcoin an opportunity to come back into the conversation as a macro hedge. Another is that we see a short-lived drop, followed by a jarring bounce if the US tries to clamp down on inflation, or if the White House intervenes more directly. If you are enjoying these insights into the hidden mechanics behind global currencies, hit subscribe so you can catch all our future deep dives. To tie everything together, let us highlight three main takeaways. First, the greenback's current predicament arises from more than just short-term politics. Yes, President Trump's Make America Great Again rhetoric set the stage for trade wars, currency jawboning, and diplomatic tension, but structural deficits, interest rate shifts, and global alliances are also converging in ways that weaken the dollar's status. Second, hard assets, gold and other precious metals, but also base metals, tend to rise when the dollar is under pressure, in part because they become relatively cheaper for foreign buyers, and, psychologically, because investors see them as a fortress in times of uncertainty. Bitcoin might follow suit, acting as a novel alternative for those skeptical of mainstream finance, though the correlation data suggests the link is less stable than it is for gold or copper. Finally, big question marks remain. Will inflation spike again, prompting the U.S. Federal Reserve to consider another rate hike campaign? Might a global conflict flare up, sending investors running back to the dollar's shelter? Or are we witnessing the dawn of a truly multipolar financial world, where bilateral currency deals and the fear of dollar-based sanctions nudge entire regions away from the greenback altogether? By keeping your eyes on interest rates, trade policies, and any sign that the major commodity importing countries are accelerating their pivot away from U.S. markets, you can stay a step ahead of the next major market swing. The moment that key support on the dollar index cracked, it was almost like the shot heard around the world for currency traders. Yet, an even bigger story may be slowly unfolding inside diplomatic circles and boardrooms, one that could alter the hierarchy of the global financial system for many years to come. Truth be told, the future path of the greenback is not preordained, but the seeds of significant change have been planted. Whether or not those seeds bear fruit depends on a tangle of variables, from central bank policies to the vigor of Chinese manufacturing. But after decades of believing the US dollar was immune to mortal threats, we might at last be witnessing the rise of truly viable currency challengers, both political and digital. Ultimately, it is up to you to decide where you stand on this. Will the greenback yield to the pressures of protectionist policy, surging deficits, and the unstoppable wave of de-dollarization? Or will it prove its resilience yet again, rallying in the face of skeptics? Keep watching. Given the swirl of events, this showdown is bound to remain one of the most captivating dramas in finance.